Welcome, everyone, to the Happy Buildings Make More Money podcast on the Rosenberg and Estes Podcast Network. I'm your host, Adam Lindenbaum. I've been a real estate litigator, dealmaker, investor in New York City and New Jersey for approximately 20 years. I'm a member of Rosenberg and Estes PC in New York, which is a full-service real estate law firm with about 90 attorneys across various departments and disciplines practicing all areas of law directly involving or tangentially related to real estate. On this podcast, we introduce you to some key players in the industry that I have met and have had the privilege of representing over the years. We talk with our guests about how they first got started in real estate and how they charted a path in this business. And my hope is that my guests will agree that a rich and trusted relationship between attorney and client is a key piece of the puzzle to achieving success. If you haven't checked out my prior episodes yet, I encourage you to do that. My first two guests, Brian Milberg of Cytex Group and Patricia Dunphy of Rockrose Development, are both current clients that I work with on a day-to-day basis. And my third guest, Dan Fasulo, he's a career real estate data and prop tech expert, a client and a friend from undergraduate whose love for real estate spawned from some unlikely sources just like mine did. Definitely worthwhile listens, as I'm sure today's episode will be. My guest today is with us. Is another great self-made success story. Ryan Goldstein, who's the principal of Invel Capital, has been active in real estate for more than 10 years. Ryan holds a BA in real estate development from Baruch School of Business and an MBA in corporate finance from NYU's Stern School of Business. Today, Ryan leads Invel's capital advisory platform and is its chief deal sourcer, underwriter, and head of investor relations with a focus on multifamily acquisitions in New York, New Jersey, and beyond. But it was Ryan's first job out of graduate school as a third-party property manager at Safeguard Realty Management when we first met. Safeguard was my very first client at Rosenberg and Estes in 2013 when I came here, and we continue to work closely together this day. And I credit Ryan and Safeguard with a few key critical developments in my skills and development as a real estate attorney, which is why I wanted to have him on the podcast today to take a walk down memory lane and to highlight his excellent accomplishments at Invel too. Welcome, Ryan.
Thank you, Adam.
How are you?
I'm wonderful. I love the platform. I watched the Rockrose podcast. Really enjoyed it. I think there couldn't be a better guy kind of bringing this discourse to the industry as a lawyer and a business person and deal maker. So yeah, it's really nice to hear you say that I was able to help in some small way. You've probably helped me in more ways and in more situations than you realize. But yeah, just for the viewers or listeners, Adam is, you're not just a good friend and very long time friend, but you're one of the sharpest litigators I've worked with. And really happy to see you have this platform and happy to join you today.
Thanks, Ryan. So let's set the stage for our listeners a little bit. It's 2013 and inside stuff about me. I had my second kid on the way and I had left my first firm of about 7 years for the opportunity to join a very large law firm and a very large law firm salary, which appeared to be a great idea at the time. But after about 6 months, the job was not for me. I knew it wasn't going to work. And but I needed to find a place. My wife wanted me out of the house. So I called up our mutual friend, Ivan Villarule, who's a principal at Safeguard, who I had worked with at my first firm. And I asked Ivan if he had an extra office that I could rent while I was contemplating my next move. So, at that time, in addition to being a managing agent for Safeguard, I believe you were the office manager at the time, and I had to onboard with you, and I don't believe we knew each other at all, really. So what do you?
I was the young kid in the company at that time, and I mean I was there 14 years ago, right out of undergrad. So I thought I knew nothing about computers and office management, but turned out I could be of value there as well, and entering the job market in '09 was interesting, and making yourself indispensable, I learned was pretty critical. So really anything and everything I could take on, I did. And yeah, you're right. That included not just, managing, I think I was brought on to asset manage one distressed failed condo conversion in the financial district. Ended up from there kind of seeping into company operations and taking on, 10, 20, up to 30 properties, office management, IT management. So it got pretty interesting. And when you joined, I think things got, a lot more fun and interesting. You might have, you know, gotten more than you expected out of coming and joining Ivan and the rest of us at Safeguard. But it was a really fun time, that short time that we overlapped there.
Right. So, I mean, it wasn't my intention to launch my own practice at the time, but I showed up on the first day and you had a beautiful sign, Law Offices of Adam Lindenbaum, waiting for me.
Yep.
That was great.
That's Ivan. That's classic Ivan.
Yeah. He liked having an in-house lawyer, I think.
and just a people pleaser by nature.
Yeah. So, what do you remember about that time? How did having me in the office change your business?
Yeah, I mean, it was great to take you out to lunch, and our lunches were pretty epic. That was kind of a staple of Safeguard culture. We worked really hard. We went to all the buildings every week. We probably spent more time in the field, like I do now, like a lot of operators and managers do. We spent a lot of time, out at the buildings, everywhere from, mostly in Brooklyn, Upper Manhattan, a little bit in the Bronx, but, Long Island, upstate New York, New Jersey. We ended up taking on a really large New Jersey portfolio, which probably laid some of the groundwork for what I ended up doing. But, we always loved kind of getting together in the office or at lunch with the team, and it really was a phenomenal culture that I have not experienced at any other company. So, very special place, and everyone kind of brought their own, interesting element to that dynamic, and you were no different. But I mean, just practically, I don't think I really knew you before you joined us in the office. I think you were at Warsaw at the time.
Right.
So we worked a little bit. But that's mostly, that's phone calls, emails, maybe getting together a bit in court if the occasion arises. But having you join, it was great. And I hadn't. It was great to have the attorney kind of right there. It's amazing how frequently you need an attorney's perspective in this business. So to have it kind of two doors down was pretty special.
Yeah. And just so you know what it did for me, I mean, it was a tremendous boost to my confidence as a lawyer because, I had written, really complex briefs and argued motions and appeals. But, to know that I had what it took to be a day-to-day advisor for a real real estate company, that was a tremendous boost that I could offer practical legal advice on an as-needed basis, to guide a company in its real estate operations. It really laid the groundwork for me to be able to do that for more clients, as I've developed at R&E.
Yeah, and I'm not sure when you made your first investment as a principal, but I made my first several and actually formed Invel while I was there, and kind of branched out shortly thereafter, and really focused on developing Invel and building the portfolio. But I think it was certainly synergistic in that way. In that you were certainly an asset to, a company that certainly didn't have, in-house counsel, and really outsourced anything and everything legal. But for you as well to kind of be entrenched in a company that is handling operations and acquisitions all day, every day, I could see that as being synergistic.
Well, your entrepreneurial spirit definitely rubbed off on me because not too long after I joined R&E, I said, I could be like Ryan. And I went out and got my first investment property, which, you give advice all day as a lawyer and it seems easy, but when it's your own money on the line, you're not always as sure of your taking your own advice. And you were great in showing up to closing with me and onboarding all the accounts that had to transfer over and help me see, things from the business side. It was another huge boost in my confidence and development as a lawyer, I think, to be able to see the business side of the deal.
Yeah, for my partners, it's always great to be there from day one. And, it's definitely an honor that, in your case as a principal, I was kind of there to help again in some small way. But you identified the property and you did kind of take the lead. And you're right, as much as having good help and good advisors and good third party vendors is very important. That you're right, there's nothing like being a principal. And without experiencing it, it's probably hard to capture. But yeah, there's nothing quite like it, and it can be pretty wonderful. It can be taxing.
Yeah.
As anyone watching this, I'm sure, is familiar on the principal side, but it can be very rewarding as well.
So let's talk about your origins. You study real estate even at the undergraduate level, which I think is rare. What drew you to the field of study?
Yeah, you're right. It's rare. You don't hear about real estate degrees, or you probably do now more than you did then. But
Well, the Shack School at NYU is famous, but that's a grad level.
didn't exist at the time,
Right.
actually. Yeah, I was drawn to real estate from a very early age. I had no family in real estate. I still have no family in real estate. I'm doing everything to keep my family out of real estate for their own sake. But I was drawn to real estate literally from the time I was a little kid. I remember, seeing buildings and just being mesmerized and curious, and crossing over the bridges into Manhattan and just being mesmerized and kind of wanting in. So I think I knew early on if I had any direction going into undergrad, which I don't think I had much, but I kind of already knew that that real estate was something I had a lot of interest in. So I went into the real estate program at Baruch, which is a really phenomenal program, and I think honestly one of the best in the city. And I did want to stay in the city. I applied elsewhere, but for many reasons, including financial reasons, I kind of limited my search to NYC and New York State. But NYC, particularly because I wanted work experience while I was in college, which I ended up, going out and getting as much as I could. And yeah, I tried to meet as many people in the field as I could. I was one of the earliest members of the real estate club in the undergraduate program at Baruch College. Ended up becoming the president of the undergraduate real estate club. And that was a great networking opportunity. And eventually got really fortunate to find that job at Safeguard, which a lot of people I'm sure remember, but in middle of '09 was the worst possible time to go out and try to find employment. So
right, that was the collapse of Lehman, that whole era.
That's right, and it's a very strange piece of my origin story, which is that while thousands of people were kind of losing their employment at Lehman, I was kind of brought on to Lehman's payroll to asset manage a distressed. It was not REO at the time, but it was headed that way. That was the one I mentioned before. But that was something that kind of felt conflicting in a sense, that all these you just had tremendous job losses at Lehman, and I was kind of coming onto Lehman's payroll at that time. It was a very strange experience. But yeah, to get that job was very lucky, very fortunate, and ended up being tremendous in just giving me real estate operational knowledge and a cursory knowledge of capital markets and financing.
So you really wasted no time. You were in undergrad, started with Safeguard, decided to go for your MBA, all pretty much at the same time. And while you were at Safeguard, you founded Invel while you were there.
That's right. I was at Safeguard for about 2 years before I went back to school at NYU. I actually applied to Shack before it was Shack, and I got rejected. It was the School of Continuing and Professional Studies, I believe, at that time, and I, just didn't have. I think the average person enrolling had about 15 years of experience, and I had 1. So they made the right call there. And then so I waited a couple months and applied to Stern, which didn't have a real estate program at the time, but it was for me, it was kind of between that and Columbia. And Columbia did not have a part-time program, and that was critical for me. I had to be part-time because I did not have the ability or desire to leave the workforce. So again, very fortunately got into Stern's part-time program and started there in 2011 after about 2 years at Safeguard.
So tell us about the birth of Invel. Well, first of all, what does the name mean, and who's in Invel with you?
Yeah, so it started at NYU, actually. My partner, also Adam Szabo, was my classmate and quickly became a friend. And, the more we talked, the more we realized we had very similar goals and a shared desire to build a real estate firm and to build a portfolio. And, he and I kind of partnered up and canvassed the entire NYC metro. I'd say excluding Manhattan, just because it was kind of, as hard as it is to break in anywhere. We saw a lot of potential. This is 2013. We were both kind of wrapping up at NYU and saying, okay, now we have our chance if we're going to, make the leap. Let's do it. So we canvassed really everywhere and identified Hudson County. So that's, Hoboken, Jersey City, Union City. Identified Hudson County as a market that had tremendous fundamentals, similar fundamentals to, some of the really hot areas of northern Brooklyn or western Queens that were really coming up. But there was a major pricing lag. There was a value disconnection. There was a sophistication disconnect. So we could just, find much better cap rates, better price per pound on similar assets with similar fundamentals and, transit access and, cool local scenes. So we kind of targeted that as a strategy. And really, since our origin, we've been a strategy-based, opportunistic investment firm. We closed our first acquisition in 2014. It was a Union City property that was fairly distressed. The owner was in the middle of litigation with some of the tenants, and we kind of sized it up. And between the basis and, preliminary, kind of underwriting of the risk and likely outcomes of that whole situation, felt like we were, getting in at a pretty good basis. And it was mostly our own capital. We brought in one person to invest with us in that deal.
So just a friend or family member?
From NYU. It was another NYU student. And we did this very similar structure on our next couple deals. That deal ended up doing really well. The litigation situation ended up working out in our favor. It was actually a rent control related dispute. Very funky situation, actually. It was two buildings that together took the property over what would be the rent control threshold, but individually would not. Right? It was 3 units in 1 unit.
So they held there was commonality of ownership and management, such that it should be viewed as one.
Yeah, probably not as well articulated, but yeah, that was the notion.
Yeah,
and I think the owner got spooked and just wanted to offload it. But we, studied the rent control ordinance, and it specifically. This is probably getting into way more granular detail than anyone needs to hear. But we studied the ordinance, and we said, what we found in there was that basically, number one, the language was plain and clear, and you can cut all this out. I know it's too much detail, but it stated rent control is on a building basis. So it does, rent control should not apply to X unit buildings as opposed to properties, as opposed to tax parcels. And there was precedent. So we found precedent in a case relating to a building in Hoboken where a very similar situation, I think, was 3 and 3. And the court there found that that the property should be exempt. This is without a lawyer,
Right. Well, that's the kind of diligence we do for our clients all the time.
Right.
You already knew about the claim because your seller was in litigation, but those are the kinds of risks that we try to identify all day long.
I would never do that deal again today, just to
Right.
be clear. I mean, we needed to get in, and we bought this property for $455,000 before credits. So it was something, thankfully there were, some banks that were willing to finance us. And it was our own money. So this is
Right.
the kind of risk that we probably, would not be looking to take in the types of deals that we're doing today, barring, just a, very high degree of confidence and a basis kind of commensurate with the risk. But we spent many a night in court with the rent leveling board and the office, rent control office. And I think after 3 hearings that went until I think 9 p.m. or so, ended up prevailing in that case. And we just made it our mission over the next several years, as long as kind of the opportunity lasted, to buy as many properties as we could of similar profile, so below rent control thresholds in these markets where there was fundamental value and a value disconnect. We tried to buy off market, we tried to buy direct, but ended up working with a lot of brokers. But it wasn't JLL or CB or Cushman. It was more often smaller mom and pop brokers who certainly know the business, but there's not necessarily the same exposure. We weren't competing against every New York investor as we would be if we were buying in Brooklyn or elsewhere, in what were considered the hotter submarkets.
Right. So is Hudson County still a sweet spot for you?
Well, yeah,
where's Invel looking today?
Sure. So yeah, that strategy kind of, I would say, expired in around 2018. So we bought, I'd say, 2 or 3 deals a year between 14 and 18. Put together a nice portfolio of those smaller buildings. By 2018, the pricing had kind of caught up with us, and those bigger players were entering the market. Both brokers and investors were entering Hudson County and kind of taking a lot of that arbitrage out of the equation. So we kind of pivoted and we decided to start selling. And in 2018, we did start selling. Of that portfolio, we sold the last 2 last year in 2022. And that portfolio did really well. But what we ended up pivoting to, I think, I mentioned earlier, we're a strategy-based opportunistic investment firm. And the next strategy that we identified was stemming from the fact that we were usually looking at heavier value add deals. And that was kind of, the mantra, it kind of still is you want to see value add, right? But what we were seeing is that value add was not pricing the way it should be. It was not pricing efficiently. And particularly, it was not rewarding the purchaser for the risk. It was kind of, you went from a dynamic where you'd buy a value add property at, a 5 cap and you'd aim to lift it up to 6.5, 7 cap. And you started seeing value add deals kind of, pricing in 3 caps because, hey, there's all this upside. The problem with that for us is that all that upside is then accruing to the seller by way of, the purchase price. And, we've financing risk, we have, downtime, we have construction risk. There's a lot of work involved. So, that's great if everything goes perfectly, but it doesn't leave much margin and it doesn't create much compensation or incentive for the risk and for the work involved. And at the same time, we would see deals, sometimes fully marketed deals, hitting our inbox. And it was the kind of thing that, conventional wisdom at the time is, okay, no, that's a core opportunity. That's a newer build. That's, what you'd call Class A. What could there possibly be to do there? What value could you create? You're not going to renovate something that just delivered last year. So, and property wasn't really old enough to have, deferred maintenance to fix or litigation to develop, to work out. And so, these deals just seemed simpler and where's the juice? But the more we looked at it, yeah.
So what's the ideal size of acquisition that you're targeting these days?
Today?
Yeah.
Well, a lot has changed. Right now, we're really not looking at anything below 25 million.
Oh, okay.
Yeah.
So that's good. So your equity sourcing has changed too. You've brought on new kinds of investors.
It has. Yeah, we've really run the spectrum. It started with some friends, and as we made some money, we started actually just Adam and me kind of putting our own capital into deals. Not even having investors. But yeah, when we made that pivot, we realized scale would become pretty important. So yeah, we did really everything from syndications, just more investors. I think the most we've had in a deal was probably about 15 or 18 investors. To now, I think just about everything we're doing is institutional equity.
Yeah. How have you handled that kind of growth? That
It's
kind of
been good. It hasn't really been that difficult because whether we realized it or not, we were kind of running our properties in what we'd consider an institutional way, very kind of defined processes and reporting, very transparent in communications and reporting. We've kind of developed the relationships over our respective times in the real estate industry. So, relationships, communication, these are the important elements in a good JV, in a good operating partner, capital partner, relationship. So it hasn't been that hard. And again, similar to on the debt financing front, we've been very fortunate to have a number of institutional capital partners that have wanted to partner with us and kind of seen the opportunity of the strategies we're pursuing. So it's been good. I think our biggest challenge is kind of sourcing quality deals.
right.
Underwriting them is not a challenge. That's kind of everything's a challenge. I'd say it's not something that we're not that we're having any issue solving for. I think our biggest bottleneck is just finding quality deals. Once we do find what we consider a quality deal, underwriting it, sizing it up, walking it, capitalizing it. These are processes that I think we have, pretty well boxed in.
So I'd venture to say that that's your major advantage over a lot of others in the field, that you have those equity relationships to bank on, and build up that trust that when the investor knows that you say go, that it's something worthwhile to jump for.
That's right. We don't send a ton of deals to our partners. Our partners might go, months without seeing anything from us. And it doesn't mean we're not busy and pounding the pavement and, underwriting 100 deals and touring. My partners are in the Bronx right now, touring something I was going to join, but then the time changed and I couldn't kind of manage them both. But
Well, we appreciate you keeping your schedule.
well, yeah, I mean, you've got to have priorities, but that's also, well, you've got to have a team. Yeah, I mean, and then we're back. We're back up. We're going to be in upstate New York on Thursday, and then I think we have something tomorrow. And so again, we're out in the field more days than we're not, and we're underwriting and walking these deals and negotiating these deals constantly, and it's very rare, just in terms of relative to the sheer number of deals that we have to look at. It's very rare for one to make sense. So yeah, I would say that that's correct. That usually for us to pick up the phone and send something along, there's probably something there.
Yeah. So what concerns do you have about the real estate industry, in the near future, long-term future?
Yeah, I probably don't have too much unique to add to there. I mean, of course, interest rates are kind of up in the air and it's been volatile, but it seems like things are kind of stabilizing, and it's been my sense really for as long as rates have been front and center, that more important than where rates end up is just that they kind of end up somewhere. You cannot really make deals reliably. You can't size up real estate reliably in a market where you just had a 75 basis point increase and you may have another 75 basis point increase in a short time. So, things are stabilizing, of course, a lot higher than they were in very recent memory. But stability is really the important thing there. And it seems that, at least on the rate front, we're out of that period of volatility, which made it just next to impossible as a seller, as a buyer, to transact. And we've been transacting less, of course, than we'd like. but rates have kept things interesting for the past year and a half. Of course, just the general economy. You hear a lot of noise every different way, good, bad, and indifferent, as far as where the economy's headed. And I won't comment, but of course, things happen, and there are cycles in this business, and you just have to be well positioned. I think going into a property with a hope that valuations just keep going up. Sometimes that works out for people. It does not work for us as a business plan. So just insulating yourself with a really good basis on every deal and a really solid business plan, protects us and gives us comfort from general macro risk. We also, everything that we have is in NYC Metro, not actually in New York City. We call it the donut around New York City. So we own in Westchester, we've owned in Connecticut, but the vast majority of what we have owned and own today is in Northern Jersey. And I would add to that Central Jersey and Philly to kind of round out our sandbox. So it's all, urban and suburban transit oriented in major markets. So, there's a lot of factors that we think are insulating us a bit from macro risk. We're thankful every day that we're not in certain sectors within real estate or even certain markets, and that our construction risk these days, construction exposure is fairly limited. We're in a few development deals. But,
so looking back over the 10 plus years that you've been, managing Invel, is there a particular acquisition or deal that you're proud of or look back as a success story for your career?
It's really hard to single out one.
Or have you fallen in love, committed the fatal sin of falling in love with one of your deals?
It's hard not to, right? They say don't get emotional.
Yeah.
About a deal, but it's impossible, at least for me. I agree with it. It makes for good decision making. You do have to be willing to walk away. You can love a deal to death, and you can have everything to gain by making a deal. But we found that you have to be willing to walk away at a certain point. But no, I mean, to answer your question, every single deal I kind of I look back on fondly, or the ones that we're in now, we're very optimistic, and everything we're in is performing really well. And they all have their stories. We're very hands-on, so we're involved in just about everything that's happening operationally. So there's always, fun surprises, we'll say, popping up in our business. And you meet a ton of characters. You see a lot of crazy stuff. You never stop learning. You never stop getting surprised.
True.
So it's unfortunately, I'd love to give you an answer, but I probably spent too much time on the Union City deal. But fond memories of all of them.
Move onward. That's the key. Okay?
Yeah.
So a lot of our listeners are lawyers or people who rely on lawyers in their day-to-day operations. What are the qualities that you seek in your counsel relationships?
Yeah, I mean, any attorney we've used has been, an organic relationship or, word of mouth. So, knowing that, someone that we trust and respect, has had great experience with an attorney, that's kind of a good starting point. But we end up working with a lot of attorneys, and I'd say, where things really kind of excel is where there's good communication, trust. Of course, the competence and just the approach is super important. With you, we have all of the above, and it's definitely been an honor to work with you on a number of things that you've helped us with, and to have you as a resource. But I would just say frame it in that context. What we've loved about working with you is not just we have an incredible working dynamic, but you see things as a principal as well as a lawyer, and you kind of need to have both. And you have not only the breadth, in terms of legal knowledge and experience, and the sharpness situationally to kind of get to the bottom of things, and that whole angle, but also on the business front, you have to be deal making, you have to be creative, you have to be outside the box. That's critical. At the end of the day, we're all running a business, and I think there's a lot to be gained by being creative and kind of seeing beyond the obvious. So we've loved certainly with you kind of see things both as a very good lawyer, but also as a business person, a practical person, and a deal maker.
Thank you, Ryan. So when that law office of Adam Lindenbaum sign was being hung, I couldn't imagine we'd be here today. Couldn't imagine what a podcast was even, right?
Right.
So here we are, not rookies in our respective careers anymore. And we're trying to put the good word out about both of our companies. Who do you want this podcast to reach?
I would say, I can't imagine it reaching any of the wrong people. I don't think there are any wrong people for it to reach. Always happy to talk to good people, whether it's other principals, brokers and deal flow sources, investors or capital partners. We're always happy to talk.
Okay.
So yeah, and all comers.
All right. Well, we'll put your contact information in the description for people to reach out to you, to
That's
Invel, to see if there's a synergy between your businesses and with R&E, with Invel directly, whatever it is. We're always happy to introduce people who have been important to us along the way, and wish them a lot of success in their businesses going forward.
All right.
Can't thank you enough, Ryan.
All right.
It was a lot of fun to catch up with you.
Thanks, Adam. Keep it up.